In the last video, we discussed the key terms, liquidity ratios and profitability ratios. In this video, we will talk about leverage ratios, efficiency ratio and market value ratios. Coming to the next one, leverage ratios. So when we talk about leverage ratio, we are talking about the leverage effect. What is leverage effect? When there is existence of fixed cost. Now, where is existence of fixed cost? In a company's balance sheet, that comes in debt. So in leverage ratio, what we try to find out is level of debt compared to equity or assets. So here we calculate ratios like debt equity, debt ratio, interest coverage ratio. It tells us about the correlation between borrowed fund and owner's fund. And what is the impact of the fixed cost on the overall efficiency and health of the business. Coming to the next one, efficiency ratios. The name itself suggests you that efficiency ratios talk about how efficiently you are utilizing the assets to generate sales. And that's why these ratios are also called turnover ratios. Here we try to assess the efficiency in terms of asset, the efficiency in terms of inventory, the efficiency in terms of receivable. So now you'll ask me what are assets. So we are referring to fixed tangible assets and fixed intangible assets. When you talk about inventory, we are referring to stock. When you talk about receivables, we are referring to account receivables, which includes debtors and bills receivable. So how efficiently the business is managing everything in relation to assets for generating sales. Last but not the least, market value ratios. Very important ratios if you want to assess the health of any company in finance industry. So market value ratios talk about market value of company stock. How do I get to know the market value of a company stock? For that, I need to know the earning per share, I need to know the price earning ratio and the dividend yield ratio. To explain it to you very simply, what's the earning per share ratio? Let's say a company has a capital structure only with equity. How would you calculate the earning per share? What will the company pay first? The company will pay first only the taxes because there is no debt, so no existence of interest, right? Taxes will be paid and whatever is remaining becomes the earning per share of the equity shareholders. Let's take another example. Capital structure of a company includes equity and debt. Now the company will pay very first interest. After deducting interest, the company will pay tax. Whatever would be remaining will go to the equity shareholders. If the capital structure of a company has equity shares, preference shares and debt, in that case, the company will pay first interest, then the company will pay tax, then the company will pay preference dividend. If any retained earnings will be taken out, whatever would be remaining will go to the equity shareholders. That's what is earning per share. So market value ratios like price earning ratio, earning per share, dividend yield, this helps us to understand what is the market value of company stock. Please remember, my dear friends, here I have only discussed the basic key terms related to ratio analysis. I'll be explaining you each ratios one by one in the upcoming videos.